Hi, everybody. My name is Zach Wilson. I'm one of the IRA specialists here at Quest Trust Company. So we wanted to be sure we got you this video because we promised you the content of going over Roth conversions, especially as we approach the end of the year and that deadline for you to do your Roth conversions for it to count for 2023. We had some technical difficulties on Saturday, but like I said, we wanted to be sure we got you this content as soon as we possibly could. So that's why we're sending it out to you now. So let's take a look and go over Roth conversions, the what, the why, and the when, all things to consider when timing your Roth conversion. So before we get started, got to give you the disclaimer, right? So everything you're about to see here is for your educational purposes only. It's important to understand the role that Quest plays when it comes to your retirement investments. We're here to offer as many resources and as much education as we can to both our clients and investors. But that being said, Quest does not offer any sort of tax, legal, or investment advice, nor do we endorse any specific investments. We're really here just to be that third-party custodian and facilitate the transactions that you want in your retirement accounts. A little bit about us, for those of you who don't know us, we are Quest Trust Company. We're the largest self-directed IRA custodian in the state of Texas. We have roughly 20,000 active investor clients all across the country. And we just hit our $3 billion in assets under management mark, which is a huge milestone for us because it's something that we've been striving for a long time. We had the opportunity to maybe take on some smaller firms and incorporate their assets under us, but we really wanted that organic growth to be sure that our clientele was never outgrowing our service and our employees, so that we can always provide that level of customer service that we promised to you. And on that note, we have over 100 employees, 34 of which are certified IRA service professionals. So what does that mean? That means when you give us a call, not only are you going to get someone who answers the phone and can answer most of the questions that you have, but we also have 34 IRA service professionals there to take that dive with you if you want to dive into the nitty gritty. So I know normally at this point we'll jump into the two types of entities, which is what we're going to go over in this next slide. But from there, this PowerPoint is going to be drastically different than the content we normally cover when it comes to the basics of a self-directed IRA. So if you're looking for the self-directed IRA basics, like the 101, go take a look at our basics class. I think the last one that we recorded was with Colin Taylor, and he did an excellent job giving you the fundamentals of self-directed IRAs, the types of accounts that can be self-directed, what self-direction really is, the advantages and the restrictions that come with those types of investment strategies. So without further ado, let's take a look. So it's important to understand how the IRS views every single entity in the United States, because it's really going to dictate why you should consider your Roth conversion at any given time. So these two categories are going to be your taxable entities and your non-taxable entities. So when we're thinking our taxable entities, at the very top of the list is you and just about anything you establish. Right, which makes sense. You go to work, you earn your W-2 income, your 1099 income, and you're taxing that income as you make it. Right, but let's say you got some assets, or you got some investments, and you're wanting to add some asset protection to those investments. So you house those investments into an LLC. Well, that LLC is also going to be a taxable entity, generally just simply passing through as like a disregarded entity to you as the owner. Next, let's go and say you form a business and you're selling a product or a service, and so you decide to establish an S Corp or a C Corp. Well, these are going to be taxable entities as well, either as the entity itself or passing through to the owners of that entity. This also includes things like trusts. So your personal property trusts, right? Those are going to be taxable entities as well. Now on the flip side, when I say non-taxable entities, what's the first thing that comes to mind? Usually a church, a nonprofit, like a charity. Right, well, your self-directed IRA is going to be considered a non-taxable entity. This is also going to include things like your qualified retirement plans. So your 401ks, your 403bs, TSPs, TRSs, right? Those accounts are all considered non-taxable. And this even extends to things like the solo 401k. Right? So whenever we're looking at a Roth conversion, it's important to understand from this point that we are dealing in this non-taxable entity. Right? So what does that really mean, right? We're talking about Roth conversion, the tax implications, but I thought we're in a non-taxable entity space. Well, the non-taxable entity description is really going to describe how the funds come into the account as a return on the investments that you're making. All right, so notice these funds are going either tax deferred or tax free, and we'll take a look at both of those scenarios and how you should weigh your options. So first, let's talk about what is a Roth conversion. Well, when we're talking about a Roth conversion, we have to understand that money really comes in two different buckets when it's in these retirement accounts. The first one is going to be your traditional IRA bucket, your tax deferred bucket. Right? I know we've labeled it the traditional IRA, but know that this is going to include also the SEP IRA and the simple IRA because it's also pre-tax for the most part. That's some caveats there that came along with Secure 2.0, but for the most part, those are going to be also tax deferred accounts. On the flip side of that, it's accounts like your Roth IRA. These are your tax-free accounts, or we say tax-free. That's in the case of a qualified distribution, kind of a description of how the earnings are growing potentially within that account. All right. So knowing that these are the two buckets that these funds are sitting in, what does a Roth conversion have to do with it? Well, it's as simple as this. A Roth conversion is just converting the funds from your traditional IRA over to your Roth IRA. That's it. It's going from a pre-tax account to a post-tax account. Now, when you're doing this, this is going to be a taxable event, right? So this has some tax implications that's important to consider whenever you're factoring in when to do your Roth conversion. Essentially, what you're looking at is the amount that you're converting from that pre-tax account, that traditional IRA, over to that Roth IRA. That amount gets added to your adjusted gross income in the year in which you did the conversion, right? So it's important to factor that in when you're timing that Roth conversion. So with that, let's get a basic understanding of what the Roth IRA is, because that's the account we're going to be moving into. And for some people, this could be the first time ever establishing a Roth IRA. So when we're understanding the Roth IRA, first we want to know the contribution limit. Well, the contribution limit is going to be in tandem with the traditional IRA. Note that these are a combined amount. So between your traditional and your Roth IRAs, all of them that you have, your contribution limit is $6,500 a year, and that's going to bump up next year by $500, going up to $7,000 a year. If you're over 50, then you're able to put in an additional $1,000 as a catch-up contribution into that IRA, into that Roth IRA or traditional IRA, whichever you choose. But know that specifically for the Roth IRA, the ability to contribute to that Roth IRA is subject to income limits. So this graph on the right side is going to show you kind of a breakdown of what that looks like. If we're filing taxes as a single or head of household, then we are going to in 2023 we are able to make a full contribution up until we make $138,000 as our modified adjusted gross income. Once we get to $138,000, between $138,000 and $153,000, it's where it starts to phase out. All right, and when I'm saying phase out, that means, well, as I get closer to 153, the less and less I'm able to contribute to that Roth IRA. Now, if I'm married filing jointly, those amounts are going to go up because I'm taking in two sources of income into consideration. So my modified adjusted gross income, if I'm married filing jointly, as long as it's below 218,000, I'm usually able to contribute to a Roth IRA. Between 218,000 and 228,000, I'm still going through that phase out. So as I get closer, again, I'm going to lose less, and I'm going to be able to make less and less of a contribution. And then past 228,000, I'm not going to be able to make any contribution at all. Now, it's important to talk to your CPA whenever making these considerations, because there's a lot of factors that go into a modified adjusted gross income. All right, so you want to be sure you have the full picture and you know exactly what that calculation is. Notice for 2024, those amounts are going to increase. So they're going up to 146 to 161 for someone filing single, and then going up to 230,000, 240,000 for someone married filing jointly. All right, so now that we have a basic understanding of the Roth IRA, let's take a look at some of the advantages associated with the Roth IRA. So first, just like the traditional IRA, prior year contributions can be funded until tax filing deadline of that year without extensions. So generally, it's going to be April 15th, unless that falls on a holiday or a weekend, in which case it gets pushed back to the next business day. All right, so notice you still have the same timeline. So for 2023 contributions, I'll have until tax filing deadline, so April 15th of 2024, to make my 2023 contributions. With that, Just like the traditional IRA, a non-working spouse qualifies for a Roth IRA contribution if they're married filing jointly and their spouse has compensation, right? Because if we're married filing jointly, the IRS sees us as one taxable entity, therefore one income. So my working spouse's compensation is going to be considered my compensation if we're married filing jointly, in which case I'm eligible or could be eligible to contribute to a Roth IRA. Qualified distributions from a Roth IRA are tax-free forever. This is a huge thing, right? This is what makes the Roth IRA such an attractive account, because as long as I'm meeting the qualifications, so I've had a Roth IRA open and funded it for 5 years, and I'm meeting one of the second qualifying events. This can be being over the age of 59 and a half, permanent disability, first-time home buyer, up to 10,000, right? As long as I have the 5-year and another qualifying event, then I can take a distribution from that Roth IRA, tax and penalty free. There's no other account that can offer that kind of opportunity for a tax and penalty free distribution. On top of that, there are no required minimum distributions, or RMDs is kind of like the acronym that you'll hear, but there's no RMDs for the original account holder. So that means by the time you reach 73, and as we go along, the age is going to get higher. But for right now, if I reach 73 with a pre-tax IRA, the IRS says, well, now I want my slice of the pie, right? You've had that tax deferred treatment for long enough. Now I want to be sure I'm getting some of that income. And so they're going to make you take required minimum distributions. Well, with a Roth IRA, right, Uncle Sam got a slice of the pie before the funds ever got in there. All right, so those contributions are not subject, the conversions are not subject, and even the earnings, in which Uncle Sam never got to touch, those are not subject to required minimum distributions, right? Again, one of the powerful aspects of a Roth IRA that really makes it that attractive account. And on top of that, you can create tax-free income for your heirs. So that means if I hold on to my Roth IRA and I meet all the qualifications where I could have taken a qualified distribution, well, then there's a potential that I can now leave my heirs tax and penalty-free inheritance. That's a powerful concept, right? If you're lucky enough, right, if you're lucky enough to be in a situation where you're not having to pull out of the IRA, it's a great way to pass that benefit on to your heirs so that they can experience the wealth that you built. So what are some considerations when we're looking to do a Roth conversion? Well, the first one is going to be, what are your assumptions about tax rates and tax laws generally in the future? This is important at all times, but right now, sitting in 2023, next year is going to be an election year, right? So regardless of which way of how you feel about that, it's important to consider, what are the tax implications going forward? Right? Is that something that maybe I want to wait and see how it goes and take my time after? Or am I nervous about it and I just think, well, maybe taxes are going to go up, so I'm just going to take the tax hit now while I'm at a lower tax rate? It's important to consider that, right? And that's just talking about the near future, right? Another thing to consider is the far future. When you reach retirement age, what are taxes going to look like then? What are the tax laws and the tax atmosphere going to look like at that point? Another consideration is, do you expect to be in a lower or higher tax bracket when you retire? This really depends on your own financial situation, right? If I think that when I retire, I'm not going to have really any source of earned income. Maybe I didn't save up too much in a 401k, so I don't expect much from my employer plans. And, I intend to take advantage of Social Security and really make that stretch as long as I can. Well, in that case, I'm going to be in a lower tax bracket down the line than I am now. So maybe that's the better time to do the conversion rather than now when I can pay a lower tax bracket. Or on the flip side, if I'm thinking my income's going to keep going up and I just want to really rip the Band-Aid off and take advantage of it now when it's at a lower amount, then maybe now's the time to do it. These are all considerations that you should sit down with the CPA, maybe a financial advisor, right, an estate planner, just to consider what you should be doing and how you should be timing these Roth conversions. Next one is, can you afford to pay the taxes from funds outside of your IRA? This is an extremely important consideration because you do not want to be blindsided by the tax obligation that comes along with your Roth conversion. All right, so whenever you're doing the Roth conversion, let's say, like I said before, if I'm doing a Roth conversion of $100,000, right? That means what I'm actually doing is adding $100,000 to my adjusted gross income for the year in which I made that conversion. Do I have the funds? Do I have liquid capital enough personally to cover the tax burden that comes along with that additional $100,000? I do not want to be caught off guard. All of a sudden, now I've got a tax obligation that I can't meet with the IRS. All right, so you want to factor that in to your considerations whenever you're doing a Roth conversion. Some more considerations are: will the conversion put you into a higher marginal tax bracket, or will it affect deductions, credits, Social Security, or Medicare due to your increased adjusted gross income? All right, this is something that not many people factor in. They don't even realize that, well, the deductions that I'm eligible for, or maybe that Social Security or the Medicare that I'm covered by, right, it's dependent upon your income. So if all of a sudden I do a Roth conversion of a large amount and now my adjusted gross income is much higher than it was, I might lose the eligibility for that coverage. I might lose the eligibility for those deductions. So you really want to be sure you're factoring that in. That's why, again, you want to talk to a tax professional whenever you're considering a Roth conversion, because there are tax implications associated with it that stretch out farther than just simply paying the taxes on the conversion. Next, do you want to leave payment of taxes to your beneficiaries? Are you willing to pay the taxes now so your beneficiaries receive a tax-free income for their lifetime? Now, this is not something necessarily, it's not something really to make you feel guilty. It's just something to consider, right? If you're lucky enough that you have both choices in front of you, do you want to take the tax hit now and leave your beneficiaries tax-free returns? Or are you in a situation in which it makes more financial sense for you to simply leave it in a pre-tax account and take the taxation hit as you distribute those funds, right? Neither way is right or wrong. You want to be sure you're just considering these things whenever you're doing the conversion. And the next one is going to be: what are your projected gains or losses on your investments? All right, so what's going to be your returns? If I do a conversion of if I do a conversion of 100,000, and let's just say, for ease of numbers, I paid 30,000 in taxes on it. Well, how long is it going to take? How long is it going to take for me to make $30,000 in gains on that 100,000 to recoup the funds that I lost personally? Right? It's important to understand from the financial aspect whenever you're doing these conversions. So let's look at how to analyze a Roth conversion. So you want to calculate the cost of your conversion, the extra taxes that you pay on the conversion income. Right, so that's just taking what's your income, you're adding it to your adjusted gross income, whatever amount that you're converting. You want to be sure, can I cover this? Right? Can I cover the tax burden that's associated? Remember, we talked about this within the considerations. So you want to calculate what's the cost of the conversion as far as your taxes go. Next, you want to calculate your recovery period. This is kind of what I mentioned before. So it's based on how long you project it will take before the tax-free income generated in the Roth IRA exceeds the tax paid and any lost opportunities to live on and or invest the money you use to pay the taxes. Right? This is what's known as your opportunity cost. Right? How long will it take? Is it going to be something that you don't think really in your lifetime that you'll ever recover? Maybe Roth conversion doesn't make sense. Or is it something that, hey, I've got time, I know this is growing, I've got investments lined up that are going to offer good returns, and I'm pretty confident that pretty soon I'll be able to recoup the funds and recoup the cost that I had to pay in taxes and my opportunity costs. Well, now Roth conversion sounds like a pretty attractive idea, right? Next is you want to decide whether the cost of paying the extra taxes now is worth the tax-free growth potential of the Roth, based on your investment assumptions and the opportunities lost by using some of your money to pay the taxes now. Right? This is going to be kind of factoring into what we talked about just before. So you want to decide whether these two costs, right, the extra taxes and the opportunity cost on the recovery period, right, you want to decide if it's worth taking the tax hit now or just leaving it down the line. I know that a lot of this is me just simply telling you, you got to consider these things, but that's really the truth of it, right? With a Roth conversion, there's no necessarily game plan. There's no blueprint that says you should do a Roth conversion at this age and you should do a Roth conversion when you have this amount. It's not that simple. And why? Is because you have to factor in your entire financial situation in order to make these decisions. So knowing that, let's take a look at some of the common questions about Roth conversions that people ask, just so we can clear up and kind of demystify the idea of Roth conversions. First one, so I thought that if I made too much money, I couldn't do a Roth conversion. Well, that's actually not true, right? Keep in mind, whenever you're doing a Roth conversion, there's no income limit, right? That income limit is on the contributions that are being made into the account. So these are the funds you're taking from your own personal checking or savings account. Anyone can turn a traditional IRA into a Roth IRA at any given time or at any age without any sort of penalty associated with that. You're just going to be looking at the taxation on the conversion like we've been talking about. Can I do a partial conversion? So essentially, can I just take a part of my account and convert it over, or do I have to take the whole sum of my account and do the conversion? You absolutely can convert all or any part of your traditional IRA into a Roth. So that's another consideration. So if I've got $100,000 and I'm deciding, man, I cannot afford the tax burden, the tax hit that's going to be associated with converting 100,000, that's perfectly fine. It was smart of you to consider that. All right, but maybe now we do 10,000 a year over the next 10 years. So I took 10,000 a year, added that to my adjusted gross income. When I calculated it, I decided that 10,000 wouldn't take me into the next tax bracket. So boom, over the next 10 years, I move a portion of it. And at the end of year 10, now I've got $100,000 in my Roth IRA to invest as I see fit. And the next one, can I convert assets into the Roth or only cash? Well, know that when you're making your contributions to the account, that you can only put in cash contributions into a Roth IRA. Well, like we said before, income limits don't affect conversions, and also the requirement for cash doesn't affect conversions. Yes, you can absolutely convert assets as well as cash from your traditional IRA to your Roth IRA. But something important to keep in mind is that the only difference is that you must establish a fair market value of the conversion, which makes sense, right? If I'm doing a conversion of cash, so again, I just go back to the $100,000 for the ease of example, $100,000 over to my Roth IRA, it's easy to tell how much I'm adding to my adjusted gross income for that year. But what if I'm doing a piece of property, maybe a promissory note, all right? Then what's the value, right? How much am I adding to my adjusted gross income? Well, that's where that fair market value comes into play. So for example, if you have an asset at Quest, if you have that real estate property at Quest and you want to do a conversion to your Roth, well, we need a hard appraisal to get the exact value that we're going to report whenever you do the conversion. For a promissory note, what we need to determine, is this an amortized note or is it a interest-only note? If it's an interest-only note, well, then the principal hasn't been affected, so that's the value of the conversion that we're going to do. If it's an amortized note, well, then we need that amortization schedule, right? We need to see where you're at on that so we can determine, okay, how much is left on the principal, and then that's the value we're going to give to the conversion whenever you do that conversion. So really, what is the ultimate question? Well, it's a simple one. The acorn or the oak tree? I know that sounds silly, but think about it this way. Do you want to pay taxes on the acorn now? Or do you want to pay taxes on the oak tree after it's grown into a large sum of money? So that's the question you need to ask yourself. Do I want to pay taxes on the acorn, or do I want to take the hit on the oak tree? And that'll be it for me, guys. Make sure you're checking out the Quest Expo. We have a lot coming up when it comes to this Expo. I'm very excited about it. It's something that we've really been taking our time and putting a lot of effort in. The reason we took the past year off, and so we wanted to be sure we did that, so that we took the time and we weren't rushing anything. We just put something together on a yearly basis, and we really wanted to focus on offering as much value as we could whenever we host this Quest Expo. So it's going to be June 27th through the 29th in 2024. It's going to be in the Irving Convention Center in Las Colinas, Texas. It'll be right outside of Dallas. So you can scan the QR code if you want to learn more. We're going to have tons and tons of speakers coming out from all across the industry. We're going to cover things about alternative assets, both inside of an IRA and outside of an IRA. We'll talk about due diligence. We're going to talk about the projections of the market, where it's going, where it's been, what we've learned, the lessons we've learned, right? And we'll cover just about every aspect of alternative asset investing that you can think of. If you have any questions, you want to talk to an IRA specialist about potentially doing a Roth conversion, scan that QR code, to set up a consultation. It's a completely free consultation with one of our IRA specialists here at Quest. Obviously, we can't give you any sort of tax advice, but what we can do is educate you on the factors to consider so that you can talk to your CPA and make the most informed decision as possible. If you want to give us a call, it's going to be 855-FUN-IRAs or 855-386-4727. You can send us an email at IRA specialist with an S at the end at questtrust.com. If you want to reach out to me directly, you can reach me at zachary.wilson@questtrust.com. Thank you so much for joining us for this class. I know, thank you for being patient. We usually are pretty consistent whenever we're issuing out these classes on our Saturdays. We ran into some issues, but we wanted to fulfill our promise of giving you the content that you needed to consider your Roth conversions for 2023. Thank you.